Welcome to Tech Talk Tuesday. I'm your host, Karla, and with me today is my fellow co-host and CMT, David Blake. It's Tuesday, April 23rd, 2024, and we have some activity to talk about that happened in the stock market last week, along with some interesting things to look out moving forward. We do it mostly from a technical perspective. David, I hope that you had a great weekend. How are you doing today?
I've had a good week. Thank you.
Great. Well, let's get started by taking a look at last week's market activity.
Okay, well, investors didn't have much fun last week. We had several bounces in the market, but every one of them was met with selling pressure. And the S&P 500, I think, and maybe even the NASDAQ, had their worst week since March of 23. So it was a pretty rough week. A lot of that was based on yields rising to their highest level since November. We had the 2-year Treasury yield bump up over 5% a couple times before ending up at 4.99. And I think the 10-year landed at 4.62. Actually, I think got up to almost 4.75 at one point. So of course we know as rates go up, equities struggle. And then we also have pushed out the Fed's expectations for the Fed's first rate cut out to September. If you remember, for a while here, we were looking at May and June, and then we keep getting further out. We had several Fed officials talking about that at this stage, the way the economy is performing, that we possibly may not get any rate cuts this year. We kind of doubt that that's going to happen. I still think we'll probably get something possibly in September, just a small one. And if you know, as rates go up, it seems to affect growth stocks, especially tech shares, and also small caps as borrowing costs become a bit more troublesome for small companies. And off of their recent highs, Philadelphia Semiconductor Index is off 9.2%. So we basically have had a correction to semis. And then the small cap Russell 2000 is down about 9.5% from its recent highs. So those two indexes for sure have had a correction. They define a correction as 10%. I think that's close enough that we could, that may be it for over the short term for that. Okay, we had some problems with conflicts with the Mideast. We saw Israel go in after Iran. Luckily, that didn't knock the cost of crude oil prices up to the 90s. It did overnight previous weekend, but then as things kind of calmed down a little bit and tensions eased, we saw crude oil prices drop down to 83 and a quarter by Friday afternoon. And then today, as things are still going on, we're seeing crude oil prices flirt with $80 a barrel. So that's kind of boosting the market a little bit. It's kind of helping to keep a floor under it. Of course, the rise in oil prices is a little bit inflationary, and they want to try to keep that down. One of the things we've been talking about recently is commodity prices. And again, we saw commodity prices continue to move higher. Gold continues to make new highs until yesterday. We were up above $2,400 an ounce. That was a new record high. But we also saw copper, which has been, moving up. Again, copper is a sign of kind of a leading indicator of economic growth. And we're seeing that hit its highest level since June of 2022 for copper. And then we're seeing the Powershares Agriculture ETF, which is DBA, that closed at the highest price in 10 years. And these are inflationary numbers that we're talking about as far as the goods have. And it's kind of worrisome to me, as the actual manufacturing goods become more expensive, it is going to be inflationary. And I think that I'm just starting to hear some of the people on TV talk about commodity index moving up to new highs, that type of thing. I think that's something that we need to watch. If you go into the ETF Center on your MarketEdge subscription on the site, you can follow some of these commodities, and they have the blended commodities and agriculture and precious metals, that type of thing. And you got to keep an eye on that stuff, because they're like I say, they're at new highs, and they cannot keep going higher without being inflationary, and that could end up, we might start to see more people talking about commodity prices moving higher, because to me that's pretty worrisome right in here.
Okay, and which sectors of the market were the laggards and which ones were the leaders?
Okay, as far as the sectors went last week, technology was the worst performing sector. It was down, I believe, 6.25%, and in fact, that sector is actually not was flat on the year at the end of Friday. It might have been up a point or two, but basically, it's given back all the gains that we saw, through since the first of the year. That was bad. We also saw consumer discretionary, REITs, communication services, and industrials also sharply lower. As far as what outperformed, we're seeing utilities go up almost daily. XLU and the Dow Jones Utility Index. A lot of that is coming from some of these big semiconductors companies talking about the need for more electricity going forward, and that utility sectors are really going to have to ramp up their production. If you're wondering why, with rates backing back up, why utilities would also be moving up, that is why. Because generally, when you have rates going up, you'll see utilities start to move down because it's more attractive to get a yield from Treasury than it is for a utility. Also, you had consumer staples were higher, financials are higher. Financials are also breaking out up here to the upside, which is good. Again, I think it was last week, as far as inflows go for financials, it was one of the best weeks with more money coming into financials than in years. It's that they were talking about today. So that's something to keep an eye on. And it seems to be across the board, whether it's insurance, banks, money center banks, regional banks, the private investment companies like Apollo or, Carlyle Group, CG, APO, Alliance Bernstein, AB. Some of those stocks are paying great dividends, and they are seeing some good money flow coming into that.
Okay, and how did the major averages finish up for the week?
Basically, at the end of last week, the Dow was up about 2 or 3 points, I think. So it was basically flat. But we saw the S&P 500 and the NASDAQ tumble for a third consecutive week. And in fact, the NASDAQ was down for a sixth week out of the last 7. So it's been, when you see that semiconductor index dropping almost 10%, you can just imagine how much that's weighing on the NASDAQ.
Okay, and how is the technical condition of the market doing?
Okay, as far as the technical condition of the market continues to be mixed. I wrote that there's some bad signs in the fact that the Dow Jones, the NASDAQ, Russell 2000, they all dropped below their respective 100-day moving average. So these support levels have been violated. We saw the S&P 500 was stuck somewhere between its 50 and 100-day moving average. And then we also had only 2 of the 11 market sectors able to stay above their 50-day moving average. That, again, showing weakness. Different sectors we're all breaking down with that also. So that's something to watch. Utilities and energy are the 2 sectors that are still, be able to hold up above their 50, and they're not at new highs, but they are still within a couple percentage points. So that's something to watch.
How's the 14-day RSI doing, and what does that tell us?
Technical indicators have slipped into negative ground. Momentum as measured by the 14-day RSI is negative. I want to mention this. I don't see it today. I should have looked at it. But on the 14-day RSI, one of the things that you may want to look at is the fact that once, they talk about the RSI being an overbought, oversold indicator. But one of the other things that you can watch with that, and Connie Brown here in Atlanta has done studies on this, is when you see the 14-day RSI drop below 40 for a period of a couple of days, that a lot of times that will mean that the trend of the market has changed. And we saw that the 14-day RSI on the different indexes was down around 35, 36. It was bouncing up yesterday, and today I don't know what it is right now, but on the upside, if the trend is now officially changed, you have to wait until, as according to Connie, you want to see the 14-day RSI has to go back above about 65. Spend a day or two there before you can notice that maybe we're back into a bullish trend. But until we see that, or unless we saw 14-day RSI jump back above 40 within a day or two, that means that probably the broader market trend is lower, but we'll kind of keep an eye on that. We did see the secondary indexes, which include the transports and the Philadelphia Semiconductor Index. They were leading the market lower with the small cap 2000. Actually, the transports and the small caps now are negative for the year. So we want to keep an eye on that. We've given up a lot here in that last couple of weeks. So market is not in good shape. However, when I mentioned mixed signals, that can hint that we would get a near-term bounce, which I talked about on Friday. And the reason I said that was the fact that MarketEdge S&P short-range oscillator, the SRO, that Kramer talks about all the time, gotten down to 5.64%, which is considered oversold for the market. And sometimes that will represent a tradable bottom. It'll bring institutional investors off the sidelines. And in fact, mentioned that on Thursday and Friday, despite the market being sharply lower, especially in the S&P 500 and NASDAQ, that underlying breadth was actually mostly positive. And that is, again, yesterday with the NASDAQ being down. What was the NASDAQ down yesterday? It was up yesterday. I apologize. But even on Friday, I think the NASDAQ was down sharply. The advanced decline lines were positive on those days, which means institutional investors were coming in off the sidelines. They were buying that dip, and I thought that with that positive divergence in breadth, we were probably due for a bounce. Whether or not how high this is going, whether it's just a oversold bounce or whether we're back in the stream of things, I think we'll end up depending on what we see here at the end of the week with the PCE report.
So whenever we see a sell-off, kind of like the one that we saw last week, what are some things that we should keep an eye on?
With the sell-off last week, one of the things you want to notice, you want to watch to see how the volume is. And that was a very orderly sell-off that we saw here over the last couple of weeks. Volume was muted. A lot of times, if things are starting to break down and people are getting worried, you'll start seeing the volume pick up, which is bad. Or maybe some investors are starting to throw in the towel. Then you'll see the VIX spike up maybe around low 20s. We didn't see that. It did get elevated on the VIX. We got up, I believe, somewhere around 16, 17, 18 last week. That's high. So it was getting to the point where, okay, the traders are getting a little nervous here, but it wasn't quite the thing where they thought, okay, we need to short this market. We're going down hard. And that was something that I said, if we do get a sell-off where we see the VIX jump up into the low 20s, that might be a signal that, okay, start to look for maybe a tradable bottom here, especially if we see positive divergence in breadth or something like that.
And how are we looking for investor sentiment?
Investor sentiment is now reverting back to more neutral stance. Just a few weeks ago, with the retail investors were 2.5 to 1 bulls to bears, and that's almost back to even now, according to the American Association of Individual Investors, the AII. And then we also have seen the hedge funds kind of they're kind of coming off. They're selling some positions in here also. They've gone from being on margin at the end of March down to a more neutral 63% exposure to indexes. So they're a little bit nervous here to boot. As far as this week's what's happening here, we're seeing the week started off with a pretty good rip yesterday. The Dow was up. Dow was up 400 points at one point in the afternoon, and then it kind of ended up with a 253 point gain. That's good. NASDAQ jumped more than 1%, and we're up. I think we're up over another percent too. We get some nice follow through.
Are there any other technical events that stand out to you at this point?
I mentioned yesterday that one of the things I noticed on a technical basis was that we saw the NASDAQ 100 and Semi Index. They got up to their, what was it, the 100-day moving average, and all three of them stalled right there. I mentioned that we wanted to watch that first thing in the morning. If we were unable to get above that 100-day moving average, we might start seeing the markets trend lower. We opened up above that, and we've continued to climb higher now in the afternoon. So that's a good point to notice. Again, underlying breadth today is very bullish. We're about at this stage here somewhere around 3-to-1 advanced incline on the NASDAQ and about about 6-to-1 on the NYSE. So they're jumping back in on this. Earnings have supported yesterday's jump. We saw was it today? General Motors had a great earnings report. Kimberly-Clark, Spotify, UPS, GE, they were all better than expected, and they also lifted guidance. A little bit disappointed from Cleveland-Cliffs and JetBlue. They traded a little bit lower, and again they're picking up. They're buying financials. That continues to be strong, along with healthcare and the technology and utilities. Again, Dow's up today for a fourth straight day. Economic data was good. We had new home sales jumped 8.8% in March. That was above the 1.1% forecast they were expecting. Well, I don't know if it's real important as it was, say, a year ago. At this stage, I think there's very little economic data out tomorrow. I think it's just mortgage apps and the EIA petroleum status report. So I think we'll trade tomorrow again off of the earnings. With Google or Alphabet setting the pace for that. I think that we're last I looked, the different indexes are headed up towards the 50-day moving average. Again, if we cross above that, you might see more institutional buyers coming in and jumping in on that. If we get up there and we stall out, that would mean we possibly are in the pattern of making a lower high, and we could start down again. Especially if there's some disappointing numbers that come out. There is some nervousness. I think the market will get a little bit choppier maybe on Wednesday afternoon and Thursday with the PCE number. That's especially the core PCE. That's the Fed's preferred inflation measure. And the fact that we've had above estimates on the CPI and PPI over the last 3 months, I think that has people nervous, as it should. Right now, we're looking for the core PCE to come in up 0.3%. That would be the same as February, and increase 2.7% year over year versus 2.8% year over year in February. And that would be if we come in line with that, I think maybe the market can, maybe start to firm up a little bit more. Hotter number, and we could see stocks roll over. Now, I mentioned last week that if we would get a hotter number, some support areas that you may want to look at. Karla, can we go to the charts?
Sure.
I just wanted to mention one of the things that I've looked at as far as where we've seen some of the things. Let's go look at the diamond, I guess, DJIA. We've kind of come down to some of the support levels and kind of went below them, dipped below them. But one of the next things here on the diamonds, you can see that this thing has really tried to hold this level here. We're at 1, 2, 3, 4, 5, about 5 or 6 days. We're trying to hold this one level here in the Dow Jones. If we see some more selling, go ahead and put the Fibonacci tracement here from the November low up to the highs there. And you can do this on your smart charts. Now, what we look at, I think that if we break down for that, you'll see this 38.2 retracement level. And as you can see, that's very close to where we had a little bit of a pullback back somewhere around December, and then a little bit almost in January, kind of came to around that same level. And that's somewhere in here around 36, probably right around 37,000. And a lot of times it's funny because on the way up, once you get to a peak and start to pull back, once you draw all these Fibonacci retracement lines in, they just happen to revert into an area where on the way up, the market maybe stumbled or had resistance levels, and then it comes back down. Those resistance levels now become support levels. So I think we could probably see the Dow, if we have a bad PC number, come down to around this 37,000 level. You can do this for the SPY. I looked at that. I think the 38% retracement level on that is around 48.20, 48.50. That'd be SPY. And you draw that in. Yeah, right around 48. what did I say? Yeah, 48.20, 48.50 is where I looked on different charts where that would be, that would be where that would probably be where we are going to get probably end up overall having probably a 10% correction in the broader market. But I don't think that's going to happen unless, like I say, we have something that's hotter than what we're looking for. And there are some people out there right now saying that the PPI is going to be which was in line here this last month, that we could probably be in line here with the PCE. If that's the case, we could see stocks firm up a little bit on that. So again, you're probably going to get for the rest of the week, you'll have some choppy trading with bouts of the big caps earnings coming in here, knocking the stocks. Maybe they go up 5%, down 5%, whether they beat or disappoint. And then watch things kind of settle down going into that PCE, because that's if we are a little bit hotter, then you're looking at then that brings up the fact that maybe September could be off the table, and then you start getting to the point where although they're neutral, it doesn't work that way in reality. You have to start thinking about election interference, and that's where I think we'll probably get a September cut, just because with the Federal Reserve, they want to keep the current president in there as long as they can. That keeps their jobs. So I would think that that'll probably still happen in September. If it's just like a quarter point, and then they say that's going to be it for a while, that would help firm up the market for the election. That's about it. I think, again, just watch the earnings in here. So far, I think about 30% of S&P 500 companies report this week, so it's a big week, and as is next week. But these big technology companies are going to move the market as they report.
Okay, well, that actually answers all of my questions, David, and we are running out of time for this week's Tech Talk Tuesday. Is there anything else that you'd like to add quickly before we wrap this up?
No, I think we're good. Again, like I say, just sit back, watch the earnings, and so far so good. I think that's good. That's helping the market bounce in here, but it all comes down to the PCE on Friday. That's the big report that will determine what we're going to do over, going into the summer.
All right. Well, thank you so much for all of the helpful information, David. We are wrapping up this week's Tech Talk Tuesday. We want to thank you to all of our listeners, new and old listeners that we've had for a long time. Thank you guys for listening. Be sure to like and subscribe so you don't miss any of our future episodes, and we will catch you again next week.